They operate in the shadows, wielding immense power over companies and livelihoods. Private equity firms, once a niche corner of finance, have become titans of industry, controlling assets worth trillions of dollars. Their decisions can make or break businesses, create fortunes for a select few, and leave a lasting impact on communities around the world. But who are these masters of the universe, and what are the consequences of their actions? This essay delves into the world of private equity, demystifying its complex mechanisms and exploring its profound impact on our lives. From leveraged buyouts to asset stripping, we'll examine the strategies private equity firms employ to generate returns for their investors. We'll also investigate the human cost of these transactions, from layoffs and wage cuts to the erosion of worker pensions and community services. This is not just a story about money, it's about power, accountability, and the future of capitalism itself. Private equity, in its simplest form, involves investing in companies that are not publicly traded on stock exchanges. These firms pool money from wealthy individuals and institutions, using this capital to acquire controlling stakes in businesses across various sectors. The goal is straightforward: buy low, improve the company's operations, and then sell high for a profit. This typically involves a period of intense restructuring, cost-cutting measures, and strategic shifts aimed at maximizing the company's value before it's sold or taken public again through an initial public offering or IPO. While the concept seems simple, the reality is far more complex. Private equity firms utilize sophisticated financial instruments and leverage to amplify their returns, often taking on significant debt in the process. This high-risk, high-reward approach can yield substantial profits, but also carries the potential for devastating losses. One of the most common strategies employed by private equity firms is the leveraged buyout, or LBO. In an LBO, the firm uses a combination of its own capital and borrowed money to acquire a company, often using the acquired company's assets as collateral for the loan. This high-debt structure allows private equity firms to control large companies with a relatively small amount of their own money, magnifying their potential gains. However, it also increases the risk for both the firm and the acquired company, as even small declines in revenue can make it difficult to service the debt. Beyond LBOs, private equity firms utilize a range of tactics to unlock value in their portfolio companies. These can include cost optimization, streamlining operations, outsourcing functions, and reducing headcount to boost profitability. Asset sales, divesting non-core assets or divisions to generate cash flow and pay down debt. Operational improvements, implementing new technologies, improving supply chains, and enhancing management practices to increase efficiency. While these strategies can be effective in driving financial performance, they often come at a cost to workers and communities. The pursuit of profit maximization in the world of private equity often leaves a trail of human casualties. As firms prioritize efficiency and returns, the impact on workers and communities can be devastating. Layoffs are a common occurrence after a private equity takeover, as firms seek to trim expenses and boost profitability. This can lead to job losses, wage stagnation, and increased economic insecurity for workers. Pension plans are also frequently targeted, with private equity firms often seeking to reduce their liabilities by cutting benefits or shifting risks onto employees. The consequences extend beyond individual workers. Communities can be ravaged as factories close, businesses shutter, and local economies struggle to cope with the fallout. The loss of tax revenue from shuttered businesses can also strain public services, leading to cuts in education, healthcare, and other essential programs. Critics argue that private equity's focus on short-term profits comes at the expense of long-term economic stability and the well-being of workers and communities. Section 5. A Tale of Two Narratives: Defenders versus Critics. The private equity industry evokes strong reactions from both its proponents and detractors. Defenders argue that private equity plays a vital role in the economy, providing much-needed capital to struggling businesses and driving innovation. They point to success stories where private equity investments have revitalized companies, created jobs, and generated significant returns for investors. These proponents also emphasize the importance of private equity in fostering entrepreneurship, arguing that the industry provides a critical source of funding for startups and emerging companies. They contend that the industry's focus on operational efficiency and growth ultimately benefits the economy as a whole. Critics, however, paint a far less rosy picture. They argue that private equity's relentless pursuit of profit often comes at the expense of workers, communities, and even the long-term health of the companies they acquire. They point to examples of leveraged buyouts that have saddled companies with crippling debt, leading to bankruptcy, asset stripping, and widespread job losses. The debate over private equity's role in society is complex and multifaceted, with valid arguments on both sides. It requires a nuanced understanding of the industry's practices, its impact on various stakeholders, and its broader implications for the future of capitalism. The world of private equity is inextricably linked to the corridors of power. The industry boasts a long history of close ties to government, with former politicians and regulators often finding lucrative second careers at private equity firms. This revolving door raises concerns about conflicts of interest, as individuals who once shaped public policy now stand to benefit from their insider knowledge and connections. The influence of private equity extends beyond individual players. The industry is a major political donor, contributing vast sums to candidates and lobbying efforts aimed at shaping legislation in its favor. This political clout gives private equity firms a significant voice in shaping the rules that govern their operations, often to the detriment of workers, consumers, and the public interest. Critics argue that this revolving door and the industry's outsized political influence undermine democratic accountability and erode public trust. They call for greater transparency and stricter regulations to address these conflicts of interest and limit the industry's undue influence on the political process. As the private equity industry continues to grow in size and influence, its future trajectory remains uncertain. Will it evolve to embrace a more responsible form of capitalism, one that prioritizes the well-being of all stakeholders, not just investors? Or will it continue down a path of unchecked expansion, driven by a relentless pursuit of profit at any cost? Some industry observers point to emerging trends that suggest a potential shift towards a more sustainable model. Impact investing, which seeks to generate both financial returns and positive social or environmental outcomes, is gaining traction within the private equity space. However, critics remain skeptical, arguing that these initiatives often amount to little more than greenwashing, a cynical attempt to appease public concerns without fundamentally altering the industry's extractive practices. They argue that true reform requires systemic changes that address the industry's deeply ingrained incentives and power structures. The future of private equity hangs in the balance, caught between the promise of innovation and the perils of unchecked greed. It remains to be seen whether the industry will rise to the challenge and embrace a more just and equitable form of capitalism. The debate over private equity cuts to the heart of a fundamental question. Can capitalism, in its current form, truly serve the common good? Or is the system inherently flawed, rigged to benefit a select few at the expense of the many? Proponents of free markets argue that capitalism, despite its imperfections, remains the most effective system for generating wealth, driving innovation, and improving living standards. They contend that the pursuit of self-interest, guided by the invisible hand of the market, ultimately leads to the greatest good for the greatest number of people. However, the rise of private equity, with its focus on short-term profits, financial engineering, and the relentless extraction of value, has cast a long shadow over this optimistic narrative. The industry's practices have exposed the inherent tensions within capitalism, highlighting the potential for market forces to exacerbate inequality, undermine social cohesion, and erode the very foundations of a just and equitable society. The challenge facing us is not to abandon capitalism altogether, but to reimagine and restructure it in a way that aligns with our values and aspirations. The time has come for a fundamental reckoning with the role of private equity in our economy and our society. We must move beyond the simplistic narratives of heroes and villains and engage in a nuanced and informed debate about the industry's practices. its impact on various stakeholders, and its broader implications for the future of capitalism. This requires a multi-pronged approach that includes increased transparency, shining a light on the often opaque world of private equity, requiring greater disclosure of ownership structures, financial dealings, and political contributions. Enhanced accountability, holding private equity firms responsible for the consequences of their actions, both intended and unintended, on workers, communities, and the environment. Strengthened regulations, implementing stricter rules to curb excessive risk-taking, prevent asset stripping, protect worker pensions, and ensure a level playing field for all market participants. We must also engage in a broader conversation about the purpose of our economy and the kind of society we want to create. Is it one where profit maximization reigns supreme, even at the expense of human well-being and the health of our planet? Or can we envision a more just and equitable system, one that prioritizes shared prosperity, environmental sustainability, and the common good? The answers to these questions will shape not only the future of private equity, but the future of capitalism itself. The stakes are high, and the time for